What I want to talk about in today's video is how to avoid a bad deal when it comes to purchasing a whole life insurance policy. What we'll look at today is a case where an individual is interested in a whole life insurance policy primarily for the cash value benefit, which frankly 99% of people we work with, that is what they are interested in. It's very common for us to hear, I'm not that interested in the death benefit, or I am, but my main focus right now is cash value. So we've got someone that fits that criteria, interested in the cash value benefit, and then what he's interested in funding a policy with is $50,000 per year for 10 years, which is a total of $500,000. So he's looking to fund the policy with a decent amount of money, $500,000, and again, he's interested in the cash value for the safety, liquidity, and then also the tax benefits that come with both the cash value and the death benefit. So the topic is avoiding a bad deal with whole life insurance. What we're going to look at first is a policy that is often sold as a high cash value policy, but it is not something that I would recommend or do for myself, or I would at least consider an additional option or two. So what we've got here is a policy where he's funding $50K per year for 10 years. But right here, these two terms are very important to be aware of. When you pay money into a life insurance policy, what you can choose is where your money is going. There's two main areas, and you can choose where they go. Your money can go toward the insurance premium, that's number one, or toward the PUA rider. PUA stands for paid up additions. I like to refer to this sometimes as a cash dump-in because the majority of that payment gets dumped straight into cash value. It does purchase you life insurance as well. That's how the life insurance company views it. You're purchasing additional life insurance. However, people that are laser focused on the cash value, this is a great way to accelerate that cash value growth. So this is often sold or explained as a high cash value life insurance policy, but it can be set up to be much, much more attractive. So as an alternate, what we can do, a lot of people aren't aware of this, is look at the same company. We can look at the same product, or we can look at a similar product. There's typically multiple products with life insurance companies. We're going to look at a similar product here. We're going to look at what's called an L99 in the original, which is more of a traditional setup. And then over here, an L95. And here's the main difference between the two. The premium in this example does not give you cash value in the first and second year of the policy. Whereas over here, this does not give you cash value in the first year. So going back to how you can choose where money goes, with the premium piece of a policy, premium dollars do not show up in cash value with most whole life insurance products in the first year and sometimes the first and second year. As time passes and you continue to make premium payments, those premium payments do come back to cash value. And by the way, you do not have to make premium payments for your whole life. In this particular example, we're going to see where premium payments stop altogether after 10 years. But premium dollars in the early years do not show up in cash value. So if the goal is to maximize cash value, what do we want to do? Or what might we do? Well, if I know my dollar amount, $50K per year in this scenario, I want to reduce the premium as low as I possibly can based on the insurance company limits and also the IRS limits, and then plow more money into the area that can help maximize my cash value growth. And remember, this will give you some death benefit as well, those PUA payments. It's typically 2 to 3x. Whatever you pay in PUAs shows up in death benefit, depends on your age and the product and such. But anyway, let's take a look at a comparison. So very, very quickly, we've got the illustrations here. This is that traditional policy, that L99. You're paying $50K per year. Here's your premium. And then over here is your PUA rider. Okay. And then let's look at the second one. So what you'll see here, your out of pocket is exactly the same, meaning how much are you paying in? $50K per year. But what's the difference? If you saw the cash value death benefit column, those likely jumped out at you. We're going to look at a side-by-side in a minute. But here's the big difference. Instead of $18,000, your premium's $4,500 and change. And then the rest, just about all of the rest, is going toward PUAs. Small amount goes toward this guy, which is a term insurance rider. We're purchasing term insurance that's added to this policy. Your total death benefit is actually whole life plus term. And the purpose of that is to avoid an MEC, which stands for Modified Endowment Contract. We're preventing that from occurring, as that will trigger a taxable event with the policy. Also, another benefit to term insurance is that it allows us to really aggressively throw money into PUAs. We do have some videos that provide a thorough breakdown and illustrations in how these term insurance riders work. I would just search term rider on our channel and you'll see a handful of videos pop up. But those are the two illustrations, and let's look at them side by side for simplicity. Here we go. On the left, we've got that more traditional setup. There's no term insurance rider attached to this policy. That had an $18,000 base premium, a $32,000 PUA payment, first year cash value, $30,000. Break-even point, year 9. That's too long, in my opinion, meaning if I'm looking at a policy, that's a long time just to get my money back, and I do view that as a lost opportunity cost. Again, that's me personally. When we look at the option to the right, what do we see here? Premiums at $5,000. To go back to that illustration, it was actually a little bit less than that. So why I have it at $5,000 there is that's the premium plus the term insurance rider. And I just rounded off. So that's the true minimum commitment there. $50K, first year cash value, almost $42,000. On the far right, in light blue, you've got your cash value difference. Right out of the gates, you've got $12,000 more. When we look at year 5, that's your break-even point, meaning the first year that the cash value is equal to or greater than your total payments. Because if you pay $50K for 5 years, that's a total of $250,000. And then what happens here? Well, the growth just continues to compound over time. So that's a quick overview of the side-by-side. What we also might show in a case like this are policies that are all designed for maximum cash value, side by side. So we've got that traditional policy, but designed with a minimum premium, or very, very close to the minimum premium, cash value maximized. Then the L95, this is the one we just looked at. And then also one that gives a bit more cash value up front. So to avoid a bad deal with a whole life insurance policy, again, if your focus is the cash value, that's what you're primarily interested in, what I would do is, one, have awareness on how a policy can be set up. Meaning when you're paying money into the policy, how much of your dollars actually show up in cash value in the first year. If it's 0, that's an old school whole life insurance policy that's purchasing a death benefit, and it'll take a long time before you see your cash value even equal to your total payments. Those typically take 10 to 15 years just to break even. That's if you make a premium payment and you've got 0 right out of the gates. If you've got anywhere between 40 and 60% of what you've paid into the policy show up in cash value in the first year, that's going to take somewhere between 7 to 10 years to break even. And then if you have a policy that has between 80 and 90% of your first year payment in cash value, that means the insurance premium was likely reduced to the minimum, and the break-even points should fall somewhere between 3 to 5, sometimes 3 to 6 years. But the cash value is optimized. You'll also find with those policies that have higher upfront cash values, the guaranteed cash values are typically at the highest numbers as well. So if you're conservative and you like looking at the guarantees, those minimum premiums will serve you well. And typically, based on the non-guarantees, you'll see more value there too. So from an awareness standpoint, have awareness of where your money is going, and see how low that premium can be. And then two, my second recommendation would be to always ask for at least one of the four major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual, simply because we've seen proof of performance from them. We've seen strong actual results, not just illustrations, but we've seen good-looking policies as time has passed, which is important because this is people's money that are going into whole life insurance policies, and they're interested in growing their money, both from a cash value and a lot of times death benefit standpoint too. So I hope this helped. Let us know if you have any questions at all, and we'll talk to you soon. Thanks so much for watching.